Hey guys, Chad Larson with MLD Wealth. It's 2023, and wanted to come to you quickly with our 2023 outlook. Wrapping up on 2022, with Friday's losses last week, the S&P fell 19.4% in 2022, its largest calendar year decline since the great financial crisis of 2008. The NASDAQ fell just over 33%. And the bond market suffered through its worst year in modern history. Nothing worked. Cash worked. With that behind us, what does 23 look like? Sadly, not great, but there is lining on the clouds, and let me explain. There are still plenty of risks that could return us to the exceptionally volatile environments that we saw in the first half of 22. So far, a settlement in the Russia-Ukraine war does not seem close at hand, and the impact of the price cap on Russian oil is uncertain. Political instability in the Middle East, while far from new, has the potential to deal another blow to energy markets at a time when the supply-demand balance is already precarious. Thus, our cautiously optimistic global economic outlook remains fraught with substantial risks. So if that intro didn't make anyone feel negative, let me explain. This is going to be the 3 R's: recession, recovery, and rebound. A fitting symmetry of a bull market that began during the pandemic with huge liquidity surge is now reconciling itself into a bear market grappling with massive liquidity drain as many factors coalesce simultaneously to tighten financial conditions. High inflation at the end of pandemic-related transfer payments, free money, reduced real disposable income in 22. However, real spending growth remain more resilient as consumers unleashed a lot of pent-up demand and shifted focus from goods spending to services spending. 23 might actually see the situation reverse as the drivers of inflation, oil prices, food prices, wage gains, and productivity gave way to the pace of inflation drops. We do expect a U.S. recession in the first half of 23, as well as a continued global economic slowdown, as last year's hawkish monetary policy and money growth slowdown works with a lag. These things take time. That should drive down corporate earnings growth and create important inflection point for investors over the next 9 to 12 months. From a market perspective, we prefer to step deliberately through this kind of turbulence as the U.S. economy weathers the fastest pace of real rate tightening in modern history. Bear markets are ultimately a function of price and time. We believe both will run their course in 23. We will expect 23 to be a volatile and challenging year as we make this transition. Paradoxically, we believe it may create strong opportunities for investors to reposition for growth and back into a more pro-risk stance as the next economic recovery and bull market emerge. This outlook, guys, it offers a roadmap of hopefully some specific advice and guidance for the coming year and some of the positioning strategies that we're employing. But as I regularly impress upon our team, advice is only as good as what can be understood and applied. And it's our job to make these words have shape, meaning, and impact for you as an investor. And we take that role extremely seriously and exercise it with the utmost care. On behalf of MLD, I want to thank you for the trust you extend us as our clients. Now, while global growth is set to worsen for some of 23, we also expect markets to start focusing on the recovery that lies beyond. We believe this calls for dynamic portfolios that are ready to pivot as a sequence of potential opportunities unfold. This includes quality investments amid present uncertainty and exposure to the sources of long-term growth. We've been talking lots over the last year about the Fed pivoting and the Fed this, the Fed that, and that the market bottom would never be called until the Fed pivoted. I think a lot of it in sentiment and enthusiasm by market participants, we're looking at when will the Fed at least pause and slow down the hikes. We're starting to see that, but a pause is not a pivot. The markets will lead and the economy will follow. And that's something we've talked a lot about. The news is going to get bad. The market trades ahead of the news and looks forward into the other side of that. So as the economic tape starts to really unwind and some of the lagging effects of, the fastest hikes in history that we've seen in modern history, the news is going to get bad. Job loss is going to be real. A lot of the job loss that we saw was job postings. there was such amount of labor needed when demand came back online, regardless of supply constraints. That I need to hire 3 or 4 people. That's our goal over the next year. If we see things slowing down, we just decide not to hire those people. Are those actual job loss? Technically, they don't show up in the numbers, but I would argue that not hiring people, that which was in our plan, is the same as job loss. So a lot of the job loss has been absorbed by just job postings being canceled. We haven't seen unemployment rise superficially quite yet. But listen, markets in 23 will lead the economic recovery we foresee in 24. So therefore, we expect 23 may ultimately provide a series of meaningful opportunities for investors who are guided by relevant market precedents. First, though, we need to get through a recession in the U.S. that has not started yet. We believe the Fed's current and expected tightening will reduce nominal spending by more than half. It'll raise U.S. unemployment above 5 and cause at least a 10% decline in corporate earnings. The Fed will likely reduce the demand for labor sufficiently to slow services inflation, just as high inventories are already curtailing goods inflation. The relative health of corporate and personal balance sheet has delayed an economic downturn for now. Household borrowing is sustaining growth presently, but this dissaving is likely unsustainable, and especially given financial market and real estate price deflation, housing prices coming down. Also, when short-term rates are higher, there's a natural bias to defer purchases. I'll remind you, and as an investor, that over the past 100 years, no bear market associated with a recession has bottomed before the recession has ever begun. Of course, there's a first time for everything, but we believe the current bear market rally is based on premature hopes that the recession will not occur, a so-called soft landing, and then there will not be a meaningful decline in corporate earnings. Having been positioned incredibly well through 2023 and carrying elevated weights of cash, having exposure to sectors such as energy, we weathered this storm, I can't stress this enough, so significantly better than our peers. But I also am respectful of the fact that relative performance versus absolute performance is not something that pays the bills. Second, we need to get through a deeper recession in Europe as it struggles through its winter of energy scarcity and inflation. And we also need to see a sustained economic recovery in China, whose prior regulatory policies and current COVID policies curtail domestic growth. Thirdly, we need to see the Fed truly pivot. Ironically, when the Fed does finally reduce rates for the first time in 23, an event that we expect after several negative employment reports, it will do so at a time when the economy is already weakening. We think this will mark a turning point that will portend the beginning of a sustained economic recovery in the US and beyond in the coming years. I want to talk to something about the great hangover. The post-COVID economic boom of 21 has given way to a bad hangover as we head into 23. As with any day after pain, today's headache will not last. But many investors find it difficult to imagine recovery. We believe change for the better will come in 23, even as markets face challenges along the way. Growth and inflation were never destined to stay in their previous narrow ranges, given the COVID shock and the war in Ukraine. Much of today's economic distortion derives from unusual disruptions to supply and vast, unpredictable swings in demand. Aggregate demand stimulus was not the right medicine for these problems. Stimulating demand without stimulating supply generated painfully high inflation. You gave people money, but you didn't give businesses the money and the opportunity to ramp up. One way to avoid a compounding hangover is to stop drinking. Tightening fiscal and monetary policy is the economic equivalent of that. U.S. federal spending has fallen 11% year to date. Real consumer goods spending has fallen about 1%, with the bulk of Fed monetary tightening impact yet to come. The slowdown in consumer spending and the sharp rise in goods inventory will put the brakes on global trade growth and corporate profits in 2023. What might mark the bottom markets amid the coming recession? As usual, producers will overreact to demand weakening, cutting output too far. Within several months of that moment, the excessive caution will be followed by reports of falling inventories. Such data points will be among the preconditions for recovery. Earnings per share will likely only follow equities higher, with the past lag having been about 6 months. Positioning for a year of challenges and change. Across 2022, investors braced for the forecast 2023 recession. The resulting bear market is well underway, although incomplete. A new bull market has never begun before a recession has even started, and most typically, a bull market begins around the midway stage of recession. The very strong communications of the Fed's intentions and the year of bearish anticipation may see markets bottom somewhat sooner than usual. However, as a late November of 2022, a recessionary decline in employment and corporate profits had not even begun. Within 2023, we expect investors to start discounting 2024's recovery. Only twice in the past century, including the Great Depression, did U.S. equities take more than 2 calendar years to find a lasting bottom, but further losses might still come. One of the things we're talking about, and we're hearing a lot of debate from clients and conversations, are diversified portfolios still a better option than cash? Perhaps disheartened by the 2022 market sell-off and enticed by rising interest rates, some investors wonder whether making substantial allocations to cash is becoming a viable strategy. We recognize that cash is now less unattractive as it used to be, and we have tactically upgraded it to neutral. We held a lot of cash through the last year, waiting for market opportunity and being decently compensated for that. But our strategic allocation to cash remains low going forward, and we see 3 reasons to remain diversified across asset classes. First, whilst cash rates have indeed increased, so have risk premium across global markets. Second, regardless of whether the Fed gets inflation under control, history shows that most asset classes should outperform cash in both scenarios, which strengthens the case for diversification. Finally, following a historic repricing episode, we believe that fixed income is now offering positive excess returns over cash rates, and this is reflected in our strategic asset allocation for 2023. To get some idea of potential asset class performance in the forthcoming period outside of our core scenario, we have to venture away from post-global financial crisis experience of near zero interest rates and base our scenarios on periods with high cash rates, the 70s, when cash rates were high and inflation kept escalating. And we're also going to look at the 80s, when cash rates were equally elevated, but inflation was brought under control. Evaluating both scenarios can give us some insight on what we may reasonably expect, regardless of whether the Fed gets inflation under control in the coming years. The first inference to be made from these scenarios is that most asset classes tend to outperform cash, even when cash rates are elevated, reinforcing the case for remaining invested in a diversified portfolio. Equities are particularly sensitive to inflation dynamics. They may struggle to do better than cash if inflation remains problematic. Think of the 70s. But they should deliver superior returns if monetary policy makers regain control, like in the 80s. Broad commodities remain a relevant hedge against particularly severe inflationary episodes, and we saw that benefit us significantly through 2022. And perhaps most interestingly, fixed income outperforms cash in both reflationary and disinflationary scenarios. In our strategic asset allocation update for 2023, we are marginally increasing our allocation to fixed income. We are putting particular emphasis on inflation-linked bonds, and as their real yields have returned to levels not seen in more than a decade. Tactically, we increased our cash allocation to neutral going into this year, but as its neutral weight, cash still represents the smallest percentage allocation in our diversified multi-asset portfolios. And we continue to advocate broad diversification across the investable asset classes as a time-tested strategy for the long run. If 2022 was the year of policy shock and awe, 2023 will be the year of living it. With that, I'm going to publish kind of a long takeaway along with this. I know verbal is great, and the visual component of it, maybe like seeing my face. But but I'm happy, and any member of our team is available for call. The worst of this is over. I'd love to have, it's January 3rd. I'm sitting at my desk, and I'd love to tell you it's straight to the top right. But, back to those three words of recession, recovery, and rebound, they happen fast. The worst, the anticipation of this and the unwinding of so much stimulus into the market, hit hard, along with the double whammy of the worst performing fixed income and bond market in modern history. I think a U.S. balanced investor, a 60-40 portfolio for a U.S. investor last year was almost negative 20. The goalie did not play any defense. I'm very, very happy of 2023 on a relative returns basis. And I think we have the game plan and the roadmap in front of us. And I'm very excited about it, because as the economic data really weakens, we're going to see the opportunity through recovery. Money's not made every year. When big returns happen, you want to make sure that your upside capture is in line. And it's a concept that I've had discussions with many of you over the last number of years. I've always felt that, the Shangri-La or the perfect portfolio is one that, has, significantly more upside capture than downside capture. And, what we can expect is, your upside capture, unless you're taking on undue risk, in a balanced, diversified portfolio, is likely, less than one. I give the example: if the market goes up by 10 and you have 80% upside capture, you're going to go up 8. If the market, then you want to have downside capture, inversely correlated. If the market goes down 10 and you only have 20% downside capture, you're going to go down 2. Over time, that formula allows for outperformance, but without taking undue risk. And so it's our job, my job as portfolio manager, to position portfolios during times where the horizon looks cloudy, to ensure that downside capture is minimized. But at some point this year, and I've been talking about it, our cash weightings have never been higher. We've flexed our cash, throughout, since going back into the onset of the COVID pandemic. We have flexed our cash weightings, aggressively to lean into opportunity, but more so to tilt away from risk. And I'm looking forward through 2023 as the minute it starts to look forward into the recovery, the markets will move. So we expect a little bit more pain. If I had to be a betting man, which we try not to be, we try to be as calculated as possible. The markets could see probably another 10% decline. And then it's it's going to be looking to be positioned for that ultimate recovery and rebound. As always, feel free to drop me a line, set up a coffee, have a call. Thank you again so much. All the best in 2023 to you and your loved ones, and have a great day. Thank you.